Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, the post-Fed pop in U.S. stock futures fading a bit this morning as Powell's attempt to ease investor concerns about growth slowing and tariff concerns fell flat.
What would you write down? I mean, it's really hard to know how this is going to work out.
And meantime, the bond market rally continuing amid that uncertain outlook, and gold pulling back slightly today after touching a record high following that rate decision.
Plus, President Trump at odds with the Federal Reserve when it comes to the rate cut outlook. The president coming out saying the Fed should cut rates as tariffs begin to work their way into the economy. Trump's post Wednesday evening comes as his administration prepares to unveil a fresh wave of tariffs, which Federal Reserve Chair Jerome Powell signaled was hanging over forecasts.
And Nvidia planning to spend hundreds of billions of dollars on investing in the U.S. CEO Jensen Huang told the FT that the latest chips designed by his company can now be produced at U.S.-based factories operated by TSMC and Foxconn, marking a major step forward in supply chain resilience for the company. Nvidia is in the midst of hosting its GTC Developers Conference and will kick off its first ever Quantum Day today.
U.S. stock futures falling this morning following the latest Federal Reserve meeting where Jerome Powell tried to ease investor concerns on growth and inflation.
Let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. Markets are pricing in break-evens some higher inflation over the next year must be related to tariffs. All forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. We're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast.
Joining us now for more is Yahoo Finance markets reporter Josh Schaefer. Josh, let's just dive into what we just heard from Fed Chair Jay Powell there.
Tariffs, right? And I think that's why equity futures might be down right now. So yesterday we had the rally, right? Post-Fed, you had the NASDAQ up almost 1.5% after that meeting. But I think largely, as we spoke to strategists on air throughout yesterday afternoon, and as strategists sort of piled in with their research notes overnight, the takes seem to be, okay, so the Fed isn't an issue right now. We don't think the Fed is basically afraid to cut based on what Jerome Powell said. But what actually started this sell-off? And what started this sell-off was uncertainty, right? We talked about this a lot throughout the beginning part of this week, sort of that tariff uncertainty overhang not being removed. That was your catalyst to sort of unwind the extended valuations that we had. Okay, we got through the Fed meeting. Really, the centerpiece of that Fed meeting yesterday was tariff uncertainty, right? So if I'm an investor coming into this morning, do I really feel any better about the outlook and any less concerned? I don't really think so, right? And then I know you guys are going to get into economic projections in a minute, but if they're projecting stickier inflation, slower growth, perhaps a stagflationary environment, there are not a lot of strategists you can talk to that say that's a good environment for corporate profits, right? And then they're also projecting growth below 2% for the next 2 years. We've talked through that talking point before too, right? If GDP is below 2%, also not typically a good environment for stocks. So I think there's, sure, maybe the Fed didn't have this crazy hawkish lean that would have made stocks sell off, but I don't think the story was necessarily changed enough for it to be a pure catalyst to get us back into risk-on mode either.
I thought the word of the day beyond being tariffs and uncertainty was also transitory.
Sure.
Is back in the room. We've got the T word back, much to the chagrin of those of us who really felt that transitory was not what happened with inflation, because by the way, it's still around years later. What does that signal about the Fed's path forward and where the market might be going? Because I guess if tariffs are going to be a transitory one-time inflationary hit, then maybe stocks aren't going to continue to sell off as much.
Yeah, right. So if tariffs are to be considered transitory, right, we'll stick with the T word here. We'll keep using it. And I think if that's the base case, which economists have argued the Fed could take that view, right? It's a one-time price pressure. Then the Fed could probably look through that. And when you look at sort of how they see inflation pacing out over the next couple of years, they see this one-time push up, but inflation falling in 2026, inflation falling in 2027. So that sort of gives you the base case for that's why they could cut. because if it's transitory, that would mean that it has nothing really to do necessarily with policy, right? And so they can still keep cutting because those price pressures are going to come, they're going to pass through, and then you get to the other side, and that's why you end up still having Fed cuts overall. I think the final point here, guys, that sort of is interesting to me is we're still sitting at 2 rate cuts projected for the year, right? And we entered yesterday projecting 2 rate cuts for the year. So I don't think that much changed from an investor perspective on what people expect the Fed to do this year. I think it was a lot of, I don't know, maybe we'll learn a little bit more in 6 weeks when they meet again.
He literally said, well, I don't know, why don't you guys do the dot plot? We don't know. We're just guessing as much as everybody else is.
That'd be a fun exercise. We should all do our own.
Yeah, we'll do
like a
Yahoo
Madness
Finance bracket for the dot plot. Josh, thank you so much, as always. Appreciate it. Well, the Fed mapping out expectations for where those interest rates could be headed with its updated economics forecast amid that backdrop of uncertainty on policy from the White House. Yahoo Finance's Alexandra Canal joins us now with a closer look. Allie, what do we know about those projections?
So the projections, at least for 2025, they were revised across the board. So we now expect higher inflation, slower economic growth, and slightly higher unemployment. So this suggests that stagflation environment, and that's something that coming into this release, markets were pretty concerned about. But the fact that we continue to see 2 rate cuts and the fact that over the long term, the projections still held up, that was an encouraging sign for markets. But you guys were just talking about a lot of the uncertainty that lies ahead. And Powell actually talked about this during the press conference. He hinted at this inertia when it comes to updating forecasts. So here's a bit more of what he had to say.
We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because, you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
So that stuck out to me because we're entering this new economy under the Trump administration, and that essentially means a strategy reset from the Federal Reserve. Remember, in 2024, we cut interest rates by 100 basis points. We were pretty much cutting for good news, right? Decelerating inflation, a solid labor market. If we're entering this stagflation environment this year, it's going to be very hard for the Fed to justify any further easing. And then if they do decide to cut, maybe that's because the economy is deteriorating more than they expected it to. So there's this new world that the Fed has been entering now. And again, a lot of that stems from the uncertainty. So even though we didn't see a lot of those projections change, a lot of experts on Wall Street are saying that the hawkish tilt from the Fed is there. They have this sort of thinking that perhaps, as you're seeing on your screen, 4 FOMC officials think maybe we won't see any type of rate cut this year. That's compared to just 1 that we saw in the December projections. We have 4 that are anticipating just 1 cut. Again, the majority see 2, but that's a projection that could change very quickly.
Yeah, I mean, the good reminder here is that we had a solid economy coming into the start of this year. And so it's really some of the rapid changes that they've been trying to make sure that in their data dependency, they're monitoring how that does get ingested by the economy, that they're able to be swift enough on either side of that outcome.
Yeah, and when it comes to the data, Powell really stressed that the hard data is what the central bank is focused on. They're not really concerned about the soft data, those sentiment readings, those consumer confident numbers. He said a lot of that uncertainty probably stems from all the trade whiplash that we've been getting over the past few weeks. But as long as the labor market remains solid, as long as we see GDP growth coming in pretty steadily, and we see this path towards 2% inflation, that's all the Fed needs to know that they're in a good position. So again, focus on the hard data. Don't concentrate as much on the soft data, and really be nimble. I think that's the message that markets are taking away from this meeting.
Absolutely. Allie, thanks so much. Appreciate it.
Thank you.
The Federal Reserve holding interest rates steady and sticking with its outlook for 2 rate cuts this year, despite expectations for higher inflation and slower economic growth. Joining us now, we've got Ken Mahoney, Mahoney Asset Management CEO, and Jeffrey Roach, who is the LPL Financial Chief Economist. Great to have you both here with us. Jeffrey, I want to start with you. How are you digesting and assessing what we heard from Fed Chair Jay Powell at the conclusion of the FOMC meeting?
Well, I think I read Powell's comments real similar to how I interpret just this morning's release out of the Bank of England. So it's not just a U.S. problem, it's around the world. I think of it in 2 main risks. One risk is the uncertainty on trade, And the second major risk is the stagflation story. And so it's an issue in Europe. It's an issue domestically. I think looking ahead, you have to look at some of the upper income consumers. Can they keep carrying the economy along like they have the last couple of years? But in sum, those are the two risks. We've certainly downgraded our GDP growth forecasts really after January's weak retail sales numbers. So we've been under a 2% number for Q1 GDP for a while now. But those are the risks. Certainly a lot to unpack.
So then, Ken, what trade does that initiate? Because the market was initially a little bit bullish after the Fed meeting. Now, obviously, we're seeing stocks selling off. The Fed meeting was a little bit meh in terms of the thesis and takeaway. Where does the market go from here?
Yeah, it's funny you say meh, because you think about it just in context. You say, wait a second, growth is coming down and inflation's going up. We want to reverse that, right? And I can't believe, by the way, they use the word transitory. Are you kidding me? Give the guy a thesaurus. How about temporary? I mean, the word transitory gives me the heebie-jeebies, like 21, 22. They said it was transitory and it was sticky for some time. So again, I'm not sure, what happened yesterday should take a major change in portfolio. I think the Fed put is still there, but remember, I've been saying since the beginning of the year, be careful what you wish for. We came into this year, everybody want 2 cuts, 3 cuts, 4 cuts. I said, you don't want any cuts. You want earnings growth, you want a strong economy, and you don't want to see a whole bunch of cuts. But here we are. I still think, especially after this forest fire that we've had the last several weeks, you still want to go with the big names, the Microsofts, the Apple, Nvidia, kind of the companies that are liquid. That's where institutions are going to come into. And if they're wrong, at least their liquidity, they can hit the bid. So I still think it big is better coming out of this. I think that kind of reaffirms what kind of Powell said. And for our clients, again, we're looking to buy on dips and try to be tactical, because this is not going to be a 2024 where a high tide lifts all ships.
Ken, it's so interesting. And just to follow on that, because some of the calls that we had heard coming into this year, especially in anticipated volatility, was, okay, the new defensive play is technology, but technology has been some of the area that's pulled back the hardest here. And so as we're thinking about it, perhaps you can kind of quell some of our perplexion on that trade.
I'll do my best. So, look, the headlines are the headlines. I mean, the 24/7 nonstop, you can't even keep up with it. No one can keep up with it. But underneath that is this huge AI spend. I mean, we came to the year thinking CapEx spending for the big, hyperscalers would be 20%. It's coming in 25 to 30%. I mean, Amazon upped their numbers from 90 billion this year to 103, $104 billion they're going to spend. Microsoft, 90 some billion. Zuckerberg and company said 60 billion this year and hundreds of billions. So again, this story is getting lost and the story is still revolving. We're in the middle innings of this AI revolution. So that's why I know it's hard to contrast what's happening from the top down with the headlines, with Powell. But as an investor, sometimes we have to kind of be like that, that horse and be like, you know what? I'm going to own these stocks. I'm going to own them long term. I welcome this price and the price is down, not because of fundamentals of these technology companies. Heck, Nvidia is cheaper than when it was just a couple months ago. The forward PE is around 25. Historically, trades 35 to 40. So this creates opportunities, and that's what we're trying to tell investors, that a lot of noise, a lot of headlines, a lot of swinging around. Be tactical, but big is better, and technology is still going to enjoy this great tailwind.
And be tactical amid the uncertainty. One of the things I'm wondering about, Ken, if you can hop back in here, is whether or not the uncertainty starts to wrap up come April 2nd when we get those reciprocal tariffs. How are you thinking about how that will impact uncertainty?
I'm not sure it will. Look, we're keying off the VIX. There's volatility, and then there's the VIX. Where it was trading at 28 just a couple of weeks ago. That's about 1.7, 1.8% intraday move. Investors want nothing to do with that. I mean, it's a great trading environment. Investors want nothing to do with that.
Right.
We need to see the VIX, like we saw yesterday, come down, kiss 20. It's a little bit elevated this morning. Yeah. But I'd like to see in that 14 to 16 range to get more aggressive, where you have kind of like, okay, we're through this. So I don't think April 2nd, by the way, thank God it's not April 1st, April Fool's Day. It's April 2nd. Well, I'm not sure it's going to clarify everything we want, Madison, but I think it's going to put us there a little bit better.
Jeff, forgive me. I want you to hop in here because as an economist, you can give us the view on whether or not that tariff uncertainty wrapping up is going to give us clarity about the path forward for the economy. What are you thinking?
Well, this is certainly a moving target. In fact, we heard that recently from the Treasury Secretary, Scott Bessent, when he was pressed on, okay, what is going to happen? Is this a 25% tariff? And then there's going to be on top of that, in additional tariffs based on reciprocal strategies. And the unknown is certainly bothering markets. I think we'll get a little bit of clarity as we get April 2nd. I think one of the things that the administration, certainly those that want to continue to take risk on and more bullish views on the markets, are going to say, hey, look, when we saw in Trump 1.0, yes, a temporary pop in some goods like appliances, but that certainly did not last very long. And so I think we're going to work through that. Certainly, as I mentioned earlier, we're going to have to track what the luxury retailers are saying about the middle and upper income households, because that certainly has been carrying the economy along. And if we can continue to see strength in that side of things, that's certainly going to help offset some of the unknowns from the tariff side.
All right, Ken and Jeffrey, thank you both so much for joining us. Appreciate it.
Thanks.
We've got some breaking news crossing the wire here. CoreWeave, AI cloud firm CoreWeave, seeking a $2.7 billion in dialed-back IPO deal. This here coming this morning. Both the offering size and the targeted valuation are smaller than investors and bankers were anticipating before the broader stock market slumped as volatility dented optimism. This is all according to reporting we're getting in from Bloomberg. Now, reminder that CoreWeave is an Nvidia-backed company, and current shareholders are marketing the shares for $47 to $55 each, according to its filing today with the SEC. So again, CoreWeave, an investor seeking to raise about $2.7 billion in this initial public offering, with those shares marketed from $47 to $55. The company had a reported revenue of $1.9 billion in 2024. Brad, as you know, we've been talking about this company. It's had deals with the likes of OpenAI, obviously backed by Nvidia. It wouldn't be surprising if it was listed on the NASDAQ. I believe it's expected to be listed on the NASDAQ given its tech leanings here. And this is something that the AI investors have certainly been monitoring.
Yeah, absolutely. Some of the fast facts here on the company. You mentioned the revenue. The revenue actually for 2024 represents 737% growth compared to 2023 here. You also think about some of the operating income margin, because that's what's going to be most focused in over the longer term and on the cadence reporting once they finally make it into the public foray here. 17% 2024 operating income margin. Now, typically for a company like CoreWeave, you're going to see that actually comped up against something that the rest of the industry uses as a standard in this rule of 40 here. So kind of looking for this to ultimately get towards, and for the adjusted operating income margin sitting at 19%. Considering how the rest of the industry usually uses that rule of 40 as kind of a guidepost, we'll see if that can ultimately get in excesses of a standard running rate in the next year of about 20%, and then seeing how they can compound on top of that. And then additionally, you think about the remaining performance obligations. This is what the company is continuing to work through via its contracts that it already has as well here. $15.1 billion right there. So all of those things considered, the RPO is what you're going to hear about. The adjusted operating income margin is more specifically going to be focused in on by investors and analysts when the company goes public and starts to get some coverage around it. And then additionally, just what the growth rate looks like as well. Right now, they have about 32 data centers. It'll be interesting to see what type of investments they're using from the funds raised in this IPO to really ramp that up as well.
Yeah, certainly a lot of additional companies connected to this one as well. I'll just quickly add, for anyone worried about the tech trade with a lot of those big tech names under pressure here, Microsoft is responsible for 2/3 of CoreWeave's annual sales, and obviously CoreWeave's annual sales being big enough to allow them to have this IPO. About 77% of the company's revenue coming from its top two customers in 2024, totaling, again, $1.9 billion. So coming up here on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, Nvidia planning to spend big on U.S. production and kicking off its Quantum Day. We'll have full coverage of that ahead. And also Nike gearing up to report results amid a shakeup in its C-suite. We'll bring you those details next. All that and more on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk a little NVDA. Nvidia reportedly set to invest billions of dollars in U.S.-made chips and electronics over the next 4 years. CEO Jensen Huang telling the Financial Times, quote, "I think we can easily see ourselves manufacturing several hundred billion of it here in the U.S. This has been, of course, some of the announcements that we've been tracking over a fast and furious GTC conference week for Nvidia. And today, they're going to be focusing in and honing in the conversation on Quantum Day, moving forward here. And we'll see exactly what they have to say on top of some of the announcements that they've already made about their investments in quantum earlier this week as well.
You've got to wonder if this announcement comes if somebody else is sitting in the White House. This is the latest tech company that we have seen increasing domestic production off the back of Trump's tariff policies. Obviously, we saw Apple talking about increasing their domestic production with billions of dollars of investment into the United States off the back of a meeting that Tim Cook, CEO of Apple, had at the White House with the president. And now we have Nvidia's decision aligning with those similar investments that we've seen from other tech firms as part of Trump's America First trade policies. What will be interesting also to monitor, and I think you've mentioned this, Brad, previously, the impact this is going to have on some of those other companies, because it's not just about Nvidia. It's also about TSMC. It's also about Intel, some of these other chip makers who are also going to be increasing their domestic chips production, especially given that $100 billion investment in TSMC and U.S. production. What is that going to look like for TSMC's involvement in U.S. manufacturing of chips?
Yeah, you can easily get whiplash from some of the announcements that have been coming out this week, and mentioning other big names out there in the landscape too, whether that's Oracle and Nvidia teaming up. They're going to be looking to try and accelerate some of the agentic AI. And then specifically, as we were talking about quantum earlier, and you mentioned some of the investments that they're making specifically here domestically, that new quantum-based research center is going to be Boston-based. So all of you Red Sox and Celtics fans out there, you got something to rejoice about. Another big quantum effort that's coming that direction. And you think about why that makes sense. Well, there's a lot of brain power that's up there and recruiting that could take place out of the Boston area. You got MIT, you got Harvard, you got all of the Ivies that they could potentially pull from. And then additionally, on top of that, looking across how they continue to have this larger kind of gatekeeper mentality, if you will. At one point, they were saying, hey, quantum's long off. And then now they're saying, well, actually, we're going to set something up, and we'll have something coming your way pretty soon.
And we'll be having some of that news today from Nvidia on Quantum Day as well. Another trending ticker we're watching today, Intel. Shares continue to drop this morning, down nearly 2%, after a Taiwan Semiconductor board member denied reports of a consortium to buy Intel's U.S. foundry business. According to a Reuters report last week, Nvidia, TSMC, AMD, Broadcom, and Qualcomm all potentially considering the purchase of Intel's chip-making facilities. NVIDIA CEO Jensen Huang also saying he is not aware of any conversations about the potential deal. Now, this is really interesting. So the Minister of Taiwan's National Development Council, he's also a TSMC board member, he said that he could state with certainty that the TSMC board said that the TSMC board has never discussed a collaboration with TSMC and Intel, according to a report from a Taiwan news agency here. So this is really interesting because we had a previous report from a news outlet that TSMC had pitched all of those companies I just mentioned about taking stakes in a JV to operate Intel's factories. That led to a huge pop in Intel stock. Now, of course, you have Intel selling off. It was down 6% as of the close yesterday, still down this morning here. I should note that year-to-date, Intel has still been on a tear. It's up about 29%.
I mean, a rebound, though, that we've been watching for shares of INTC. And you mentioned some great points within that, especially in the he said, she said of this all. And one thing that really matters is how this would actually bring some of the chip fabrication process to a U.S. entity. As you mentioned, the administration right now is really laser focused on trying to bring back some of that to domestic production, knowing the reliance that we've had for years now on overseas, and especially in Taiwan Semiconductor. Now, Taiwan Semi, for their own right, they've announced in tandem, essentially, with the Trump administration, trying to make sure that they roll out the red carpet for any company that makes major and significant investments. For Taiwan Semi, there's actually some benefits if they do pursue this further, because that keeps a lot of the production underneath of at least your oversight. And so with that in mind, as they've already been essentially the market leader in that foundry effort, it's a larger consideration of, all right, how much of that market share would they retain if they were continuing to pursue this joint venture and have some oversight, have some sway within that, versus if they did not and had to deploy those dollars that they promised to the administration elsewhere, and what would that look like in in actuation. I know that's not the word, but
in
reality of it.
Especially given that chart, that great chart we just had showing just the degree of chips made outside of the U.S. And the goal, of course, is to flip that dynamic.
In deployment of those dollars,
There you
I
go.
should have said.
Perfect.
There we go. All right, let's shift gears here. Let's talk a little Nike. Nike set to report fiscal third quarter earnings after the close today. This will be the second earnings report since Elliott Hill took over as CEO in October. Investors, they're going to be looking for progress and those updates on Hill's turnaround strategy and comments about the impact of tariffs on the footwear industry. I think most notably here, it comes back to what the street is going to be listening for in guidance. Do we get a resumption of guidance? Do we ultimately, within this strategy, and especially in the shuffling of some of the alignment and restructuring internally, how does that better focus the organization, I suppose, in being able to turn around some of the shareholder value slippage that we've seen here, and how quickly does that come to fruition?
Yeah, obviously Nike is very overexposed to Asia. That's an environment that has been under pressure. I think Piper Sandler puts a pin in it really well. The analyst over there saying the key on the direction of the stock, whether Nike can return to growth as innovation is scaling up, and there have been some concerns about their inventory. Of course, we will get the news on that during their earnings print today. All your markets action ahead, so stay tuned for more. You're watching Morning Brief. That is your opening bell on Wall Street. Let's take a look at the market action. If you take a look at futures coming off their highs from earlier this morning, we did see a little bit of a recovery in the market off the back of that Fed meeting. The Fed keeping rates steady, but slowing their growth expectations, also looking at an increase in unemployment. The market, interestingly, rallying off the back of that meeting. Maybe it was about what Fed Chair Powell didn't say. He never used the word hike. Maybe taking a hike off the table was enough to lead to a little bit of a rally. But as you can see today, that rally coming off of its skis here a bit. You've got your tech-heavy names responsible for the majority of the losses here. Your S&P 500 is down about 0.7%, and you continue to see a lot of pressure on those tech names. I'm just going to flip the board over to the NASDAQ so we can take a look at all of your Mag 7 names in the red today. A very different picture than that pesto pizza I was able to show you guys yesterday. You've got Apple down about 0.9%. Nvidia, this is going to be the key driver of the group potentially today, down about 0.2%. If we get some positive headlines out of their quantum day at GTC today, is that going to be enough to bring the rest of the ships with it? Of course, that is the trend that we typically see with Nvidia, but that has been under pressure as of late with the rest of those tech names. And then you've got your big laggard for the Mag 7 year to date in Tesla here, which is down 0.6% in the trade today. I'm going to head over to Jared Blickery for a broader look at what's moving in the markets. Hey, Jared.
Thank you, Maddie. I'm going to go back to the indices where we have small caps leading down today, and we have been in the midst of this fledgling rally since last Friday, trying to get off the ground, but each time we get a win, and we got 2 wins back-to-back Friday, Monday, but we've been getting these big loss days intervening, and here we can see this is a 4-day look. Let me put the 5-day, and you can see S&P 500 still hasn't really eclipsed those highs that we saw on Monday. The good news is we've been talking about seasonality a lot, especially over the last few years. March seasonality finally turns bullish, and a few different models say a few different things, but March seasonality is turning bullish today, and so that kind of takes some pressure off the stocks. I'm going to be doing a deep dive on that in about 30 minutes. And let's get to the bond market, because the 10-year T-note yield has now fallen to the lowest level in quite some time, a few weeks there. Let me put, that's a 5-day chart. I'm going to put a year-to-date on so you can see the price action in there, right by these lows that we've seen. So what's interesting is the 10-year T-note yield is falling, and it's not by a little, it's by a medium amount, 7 basis points. Meanwhile, the US dollar index is rallying to the highest in a couple weeks. And so I think that dynamic is interesting, worth monitoring. Not sure what it means or what it's saying so far, but keep my eye on that. And here we have, look, utilities flipped into the green there, but tech is leading the way down. So is industrials, energy, materials. So kind of a mix of cyclical, mainly cyclicals, leading the way down today. I want to get over to the NASDAQ 100. And specifically, I saw this Bespoke X post, and it was interesting because I didn't realize how many of these stocks are in, it's not appropriate to say a bear market, but a lot of these stocks down 20% or more. I'm going to put a view here that shows how much each of these stocks are off from their 52-week high, and you can see Apple's down 17.5%, Nvidia's down 22%, Alphabet down 21%, Meta 20%, Tesla 51% here, and Amazon almost at that 20% threshold too. By definition, we're not going to see any green on the screen because this is down from the 52-week high, the highest point over the last year. But I thought that was kind of instructive, especially as we see Apple, Meta, and Tesla down double digits in March. I want to switch over to Chinese stocks, which have been a real bright spot this year. And this is what's happening today. This is actual return losses. And Alibaba down 3.5%, Trip.com almost 4%, Xpeng down 5%. So we're seeing a lot of weakness in the China trade today. And then we can go to futures land where we see copper. Copper is flirting with all-time highs. HG equals F. Down about 65 basis points right now, but it was poking into some really heady territory earlier on. I've been showing this max chart, which goes back over 20 years to the early 2000s, and you can't see it on an intraday basis. We do have a few highs in here to deal with that might be a little higher, but we're basically at record highs in copper, and that has big implications for the industrial complex all around the world. I'm going to leave us with Bitcoin. Crypto caught a bid yesterday after Chair Powell took the lectern. And let's get a 5-day view of crypto because it was camping out near the low 80,000s, wasn't doing much. This is a year-to-date look, but finally got a little bit of a lift-off here. So the highest point in a couple weeks. And once again, we did get that lift-off of the 200-day moving average, a key technical level, but we just haven't seen much traction in either direction since then. And yeah, we'll wait for that next catalyst, Brad.
Jared, thanks so much. We are waiting for that next catalyst indeed. Appreciate it. Time now for today's strategy session. The $29 trillion bond market is seeing its rally continue today. As Fed Chair Jerome Powell, well, at least it was seeing its rally continue. Fed Chair Jerome Powell tries to ease growth and inflation concerns. So what's the bull and what's the bear case as the bears are having their way at least early out the gates this morning for the markets as investors and the Fed grapple with growing uncertainty. Joining us now, we've got George Catrambone, who is the DWS Group Head of Fixed Income and Head of Trading here. So you saw the market action that we're seeing in the bond landscape right now. Why do you think that's playing out post yesterday's Fed announcement?
It's a reaction to Powell. He was great yesterday. One of his better press conferences. 10-2 on the steering wheel, middle lane, keeping up with traffic. And, I guess really doing a good job from what people were worried about going into this, which was that, yeah, of course, unemployment may go up, inflation may go up, growth may come down. What about those cuts? And leaving 2 cuts in that dot plot, I think, is what relaxed everybody and really calmed the bond market from where we were going in.
You laid out a bull and a bear case for the market in your notes over to us, which gave me a lot of clarity. And what is the only thing that's certain is the uncertainty right now.
That's right.
Can you walk our audience through that bull and bear case, and which of the two you think is more likely right now?
Yeah, look, right now, from a bull perspective, unemployment rate is only at 4.1%. We had 150 in payroll ads. Capital markets are functioning. IG spreads are pretty tight. So it's really not that bad. And right now, the soft data could be head faking that hard data. So I think that's the bull case that we've seen these kind of spooks before. We saw NFP in Q3, CPI in Q4, and now Q1 we had this sort of growth scare that's there. So it really could be a storm in a teacup. And we had a negative GDP in Q1 of 2024 as well. And look how that year turned out. The bear case is this is a K-shaped economy that we don't have any more pricing power left. The consumer is really shot, and now this uncertainty is forcing companies to pull back, consumers to pull back, and there's really no fiscal impulse this time around with Trump and the kind of the cutbacks that are happening with Doge and in government spending and otherwise. So
Yeah.
those are the two sort of bull and bears, and no one really has that certainty and clarity right now. Maybe Trump does, but that's what you're seeing in this push and pull right now of the market.
And so with all of this, I'm focused in and I'm locked in on what we had on the screen a moment ago in the 10-year, because that 10-year is more tied to mortgage rates, and shelter has been the stickiest portion of inflation. Are these moves material enough for there to be some easing in the pressure that we've seen from the shelter component side as the Fed is reading through and trying to best gauge what their next step should be?
Well, it's been coming down. And if anything, goods has been more of a concern in Powell's press conference yesterday. So it's slow. Shelter and rents tend to reset every year. And Trump and Bissent is the world's largest bond salesman. That's why they're very keen to bring down that 10-year benchmark rate. And it's come down most weeks that Trump's actually been in office. And I think that's their priority, is to get that down to help housing and understand that shelter and our housing markets are a large part of our overall economy.
Talk to me about this line in particular, about where manufacturing is heading in the U.S. You said, I'm not sure the U.S. can structurally become a pure manufacturing economy unless wages nosedive.
Yeah.
Would that force the Fed's hand if we do see a nosedive in wages?
It could, but it's not this Rosie the Riveter kind of situation coming back like Trump may project with this 3% productivity and production kind of coming back. I just think structurally where wages are, and right now where we are, and especially in cutting off immigration, that's ultimately a headwind to coming back to that. Now maybe in the AI, and that was sort of the hope until DeepSeek kind of came along, and we'll still see where that goes. So if you're looking for that kind of manufacturing to come back, I think it is in the AI sector, it's in data centers, and it's in that area. I'm not sure it actually comes back to manufacturing. You and I have talked beige book in the past, and manufacturing looks so bad. Global PMIs and PMIs are above 50, so there's something to that. I don't know about getting all the way back to where we were again as a manufacturing powerhouse.
Where does the U.S. exceptionalism trade sit within the fixed income landscape right now?
Well, for the moment, we're passing the baton over to Europe because that's where the interest has been. That's where yields have gone a little bit higher. And that's where the spending is right now, right? Fiscal is coming down here and theoretically going up there. So for the moment, we're going to take a pause and hand it to Europe. But there's another structural question for me. Will they be able to actually ramp up their production and productivity in a way, or will ultimately the money funnel back here?
We don't all have the same AI?
Not only do we have the same AI, but we have the same manufacturing as it relates to defense. Like Airbus can only do so much.
And final 30 seconds, George. One of my questions to you on set was the global demand we're seeing for U.S. bonds. You actually think that's not a huge risk to the U.S. economy?
It's not. And there's plenty of room for the Europe and the U.S. to be there. And I think from a Treasury perspective, this question comes up a lot. And foreign demand has been coming down all along. So I don't think that's been a major headwind, and auctions have really been behaving thus far. So keep an eye there, but until auctions and Bob vigilantism comes back, I'm not concerned.
Watch the vigilantes always. George, thank you so much. Always great having you. Appreciate it. Coming up, we're going to take a look at oil following President Trump's meeting with energy executives. That's coming up next on Morning Brief. Top energy companies outperforming the S&P 500 so far this year, coming as oil CEOs attended a meeting at the White House on Wednesday afternoon. Here with more, we got Ed Hers, University of Houston's energy fellow. Ed, it's great to speak with you here. When you look at that chart and you see energy outperforming the S&P 500 in a moment with so much uncertainty about where this market is heading, investors who are in on those energy names want this dynamic to continue. What does the Trump administration have to do to not stand in the way of the momentum of these energy names?
It's going to be very difficult. Keep in mind the energy portion of the S&P 500 has underperformed everything in the S&P 500 for the last dozen years. The fact of the matter is the U.S. is the high-cost producer for oil in the global market. OPEC Plus has increased production, acknowledging the cheating that's been going on. And the target is a much lower oil price. Trump, during the campaign, said that he wanted $1.87 a gallon gasoline. Well, that would mean the price of oil would have to be below $50 a barrel. And that will really hammer oil development across the United States. In the Dallas Federal Reserve survey of the last quarter of 2024, more than 80% of the producers said they were not going to consider investing unless they could see a sustained price of greater than $70 a barrel.
So with that in mind, it sounds like drill baby drill would be more adverse actually to some of the companies that have their fiduciary duty to investors as well to maintain a certain profit margin and operating margin that they've been able to deliver for years at this juncture.
Yeah, drill baby drill is not going to happen. The oil execs have explained that to the president. Scott Sheffield last week, the former CEO of Pioneer, who's told his company Exxon, said that they had run through their tier one acreage, and the acreage is becoming gassier. The fact that the market is in favor of the energy stocks right at this moment really is pointing towards gas and a prospect of using more natural gas for LNG exports and for electricity generation. But as we know, the backlog for gas turbines is well out into the 30s at this point. We're not going to be able to pivot that quickly. The LNG facilities that are underway are going to come on incrementally. We have a huge amount of natural gas that's stranded because of a lack of pipelines. Keep in mind that in Trump 1.0, both the Constitution and the Atlantic pipeline were canceled. If those had been in place, we would certainly see a rosier future for some of the gas producers.
We've talked a lot about the impact of tariffs on oil and gas. What about the impact of immigration policy?
I think that's something very few people outside of the oil patch have focused upon. Joe Sixpack is not going to go work on a rig floor in 150-degree heat in West Texas. And if mass deportations come to West Texas, we're going to see maybe a drop of 10 to 20% in the workforce. We also know that the contractors that work across the refineries and the petrochemical complex hire a lot of undocumented workers. It's plausible deniability for the owners of these refineries. Houston has about 600,000 undocumented workers. So there's going to be a squeeze on the cost side for all of these oil and natural gas producers, from the steel, from the aluminum, and then from the workforce.
You also have an input where there's going to be more production, I believe, coming out of Libya, one of the areas. And then even as OPEC considers the non-members, I should say, that are going to be increasing their production at a time where they're trying to best coordinate with their OPEC Plus members about where production should stay in order for oil markets not to be amazingly volatile. How do you evaluate some of those new inputs for production internationally?
Well, the new inputs have been coming along. Guyana, which is an Exxon Hess development, has been doing really pretty well. It's 1 million barrels a day, potential up to 2.5 million barrels a day. Libya is coming back online. Russia has been exporting more oil than it was producing prior to the invasion of Ukraine. This oil gets to market. We're 103 million barrels a day, roughly. We've never had a larger oil market. And every producer across the globe is a lower cost producer than the United States. They can run us off the table anytime. We remember the price war that kicked off in 2014 against the shale plays. We also recall that in Trump 1.0, the president told MBS that the price for getting away with murder was low oil prices, and Saudi Arabia followed up with lower oil prices. The new high 13 million plus barrels a day came during the Biden administration. It doesn't look like the Trump administration is going to really be able to do anything to expand production and maintain a low price.
Ed, thanks so much for the context and the insights here. Appreciate the analysis. All your markets action straight ahead. Stay tuned. You're watching The Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, Tesla is recalling all Cybertrucks sold in the U.S. since launching over a safety issue. The problem stems from adhesive on the steel trim on the exterior of the car that could weaken over time. Tesla will foot the bill for the fix. The correction in production is planned for Friday, and the EV maker estimates that 1% of 46,000 plus trucks have this defect. This is Tesla's sixth recall of the Cybertruck since its launch.
Plus, Temu owner PDD Holdings missing revenue expectations in the fourth quarter. This was the third consecutive quarter that sales missed estimates. It comes amid growing domestic competition and trade uncertainties in the global markets. Rivals JD.com and Alibaba recently reported better than projected sales as Beijing is ramping up policies meant to boost spending.
And finally, Five Below beating on the top and bottom line in the fourth quarter, also guiding to a strong first quarter. For the full year, the upper end of the net sales guidance beat analysts' estimates. Earnings per share is projected to be lower than what analysts expected. Wall Street is cautious on the impact of tariffs. Morgan Stanley saying tariffs present a significant margin headwind, cutting its price targets to $110 a share from $120. Barclays also lowering its price target to $93 a share from $100.
All right, let's do a quick check of the markets as we head to break here. You're still seeing that selling continuing this morning, but recovering just a bit from where we were at the market open. I did have your NASDAQ off nearly 0.9%. Now we're down just about 0.1%. Your S&P 500 down about 0.2%. If we can flip the board over to the Treasury market, we'll see a continuation of yields moving to the downside here as prices rising again in the bond market here. That perhaps also adding to a little bit of the pressure that you're seeing on the stock market, but still your stock market maintaining a little bit of its moves. And there you've got your 10-year off of that 4.2 handle. This has been interesting because the 10-year has been holding steadily above that 4.2 level. You've got it now just below that level as of this morning's trading action, as you're seeing prices continuing to rise as treasuries continue to catch a bid here. That is going to do it for the morning brief for now, but join me in the next hour for more analysis that you can catch on Catalyst, and then you'll have Brad for Wealth after that with all of your personal finance needs. So stick around for more.